So if you're an innovator in the crypto space, especially if you're looking at issuing a stablecoin or, some token backed by real-world assets of the European Union, it really looks like the ultimate prize.
Oh, absolutely. It's a massive unified market. You're talking about 27 nations, nearly 500 million affluent consumers. It's huge.
But here's the catch, and it's a big one. Accessing that market today means navigating a regulatory structure so complex, so uh, dense, that trying to go it alone isn't just risky, it's financially suicidal.
Right. And that regulatory structure has just fundamentally changed the game. We're talking about MiCA, the markets in crypto assets regulation.
And we're getting it specific today.
Very specific. We're drilling down on something called asset reference tokens, or RRTs. This is the official legal term for any crypto asset that's designed to maintain a stable value by referencing, well, anything from official currencies, like a euro stablecoin.
The equivalent of a fiat-backed token.
Exactly. Or it could be commodities or even a whole basket of financial instruments.
And the stakes here are just immense. We're not talking about just filing some paperwork.
No. This is about securing a license to operate what is essentially a modern financial institution on the blockchain.
So our mission for this deep dive is to really get into the mandatory, and I mean highly complex, legal authorization process for these RDs under MiCA.
And we want to show, using our sources, why trying to do this solo is it's a blueprint for catastrophic failure.
And we have a number to back that up. We're going to explain why skipping the expert legal guidance could cost an entrepreneur, and this isn't an exaggeration. It's based on a quantified analysis of what can go wrong, up to 2.4 million euros in total losses.
And that figure, that's the real cost. It's the cost of delay, of getting rejected, of having to do operational redesigns, and all the lost revenue. It's the cost of bad planning.
And the legal reality is now crystal clear.
It is. Since June 30, 2024, it's absolute. If you want to publicly offer an RT or get it listed for trading anywhere in the EU, you need formal authorization from a national regulator, like the Czech National Bank or the regulator in Germany or Ireland.
And if you don't have it,
it's not a fine. It's criminal prosecution, it's asset seizure, and it's a permanent, devastating shutdown of your business. This isn't a fringe tech activity anymore. It's a licensed, regulated financial service.
Okay, so let's unpack that. This is a monumental shift. We are literally moving from the old, unregulated crypto Wild West.
Move fast and break things.
Yes, exactly. And we're moving directly into this meticulously landscaped, high-stakes corporate financial district, the level of due diligence, the accountability. It's a whole different ballgame. So MiCA is implemented. And the first critical point our sources really hammer home is that this is not optional guidance. This isn't something you can, try to lobby away in a couple of years.
No, it is binding codified law across all 27 EU member states. It creates this unified legal front that completely removes any possibility of, say, shopping around for the easiest regulator.
So no regulatory arbitrage between countries.
Gone. And that unified structure is both the promise and the peril. If you want to issue an RT publicly, whether it's in Portugal or Poland, you have to comply with the exact same set of requirements.
And MiCA is very clear on who can issue these tokens.
Extremely precise. Authorization is mandatory, and it's only for a legal entity established within the EU. We're talking about a proper company, a partnership, a foundation, some kind of legally accountable entity.
Which right away rules out that classic sort of decentralized solo dev model that really defined the early days of Web3.
Oh, completely.
Yeah.
You can't just launch a smart contract and stay anonymous. Private individuals are explicitly prohibited from issuing these tokens.
So from day one, you have to have institutional structure.
You need governance, accountability. It's a massive shift. It's forcing crypto innovation to basically grow up and conform to established corporate compliance standards.
Okay, so that's the rule. But in any big regulation like this, entrepreneurs immediately start looking for the loophole, right? The narrow path, the exemption that lets them test the waters without going through the whole 9 yards.
And there are a couple of main exemptions, but it's crucial to understand how our sources frame them. They're not ways to avoid compliance. They're avenues for a simpler notification process. You still have to do the work.
So compliance documentation is unavoidable.
Unavoidable.
All right, let's look at the first one, the size exemption.
Okay, so this is really aimed at small-scale operations or maybe a proof of concept. You can avoid the full intensive authorization process if the average outstanding value of your RT never goes above 5 million euros.
5 million, and that's over a rolling 12-month period.
Correct. And critically, you also can't be linked to a network of other exempt issuers who are trying to sort of pool their tokens together to get around that limit. The regulators are very wise to those kinds of aggregation tactics.
5 million euros in circulation. I mean, that's pretty modest in the financial world. It's a useful test bed for a new product, but it's not scale.
It's not scale at all. And the moment you cross that 5 million euro threshold, the full authorization hammer drops. You'd better have your full application ready to go.
And the second path is more about who you're selling to, the qualified investor exemption.
Right. So if your RT is offered only to sophisticated institutions, we're talking established banks, large corporate investment funds, qualified private equity, and if it can be held only by those qualified investors, you might also be exempt from the full authorization process. This is the institutional lane.
But I want to circle back to what you said earlier. Even if you meet these exemptions, you are still deep in the world of compliance. You can't just ignore MiCA.
Absolutely not. And this is a huge trap for unwary entrepreneurs. If you qualify for an exemption, you still have to prepare a comprehensive crypto asset white paper that meets all of MiCA's disclosure and risk warning requirements. And you have to formally notify your national regulator about what you're doing.
So the paperwork is still mandatory.
The compliance documentation is mandatory. You get to skip the 6-month formal assessment cycle, but you absolutely cannot escape the underlying responsibilities of being truthful, being clear, and structurally adhering to the law.
So whether you're fully authorized or just notified, that commitment to institutional standards is non-negotiable. It's sort of like being a small business that still has to file detailed tax returns. The process might be lighter, but the responsibility is the same.
That's a perfect analogy. And this brings us to the really high stakes. Let's imagine a company, maybe founded by someone who still believes in that old mantra of ask for forgiveness, not permission, and they decide to launch without getting authorization. What happens? What are the immediate catastrophic consequences?
That ask for forgiveness mentality is about to run headfirst into criminal law, isn't it?
It is. The outcomes are severe and they are immediate. First, you are looking at criminal prosecution for operating unauthorized financial services. This isn't some civil dispute, it's a criminal matter where the state is accusing you of performing a regulated activity without a license.
And criminal prosecution implies personal consequences for the directors and management. We're talking about things that go way beyond the company itself, like jail time or professional disqualification.
That's precisely what the source material stresses. There is explicit personal liability for company directors and management. Then, on the civil side, regulators can impose enormous penalties, tens of thousands of euros for small things, but escalating into the millions for operating without a license.
And what happens to the actual business itself beyond the fines?
The regulator will issue an order for the immediate suspension of operations. Your smart contracts get frozen, bank accounts shut down, your system is disconnected, the business stops dead.
And that's often followed by asset seizure.
Yes. The regulator takes control of company assets, including the token reserves, to protect consumers and settle any claims.
So if a business is shut down and the assets are seized, I mean, the long-term damage must be fatal even if you eventually settle the fines.
It leads to total and complete reputational destruction. If you launch without authorization and get shut down, you instantly lose the ability to get EU banking partners, payment rails like SWIFT, any institutional trust. Your company just becomes financial roadkill overnight.
No legitimate fund will invest. No major exchange will list your token.
The entire business model just collapses because the foundation of trust is gone. And that is why specialized legal representation isn't just a cost. It's the fundamental insurance policy against corporate death.
This brings us right to the core problem then. We know the stakes are astronomical, so why does that entrepreneurial instinct to save the initial legal fee and do it myself predictably lead to failure in this MiCA environment? I mean, most founders think they can handle high-level documentation, but this is clearly a different beast.
It's a whole different beast because it requires you to synthesize financial law, European corporate governance, and cutting-edge tech security. Sources are very clear about why an application filed without specialized MiCA experience is just. It's doomed to fail.
Okay, let's start with the most brutal consequence you mentioned, outright rejection.
Rejection is failure point number one, and it's catastrophic because of the time penalty it imposes. The MiCA application demands 13 distinct, very complex categories of documentation.
13.
13. We're talking about everything from the token's public white paper, detailed corporate governance policies, specific ICT security protocols, AML and KYC procedures, and most crucially, detailed reserve asset management policies.
13 categories of interconnected, highly technical documents. That sounds like it requires immense coordination and, well, specific legal templates.
It does. And the rule is absolutely unforgiving. If you are missing just one required document, or if the regulator decides that document isn't deep enough, say, your white paper is vague about technology risks, it results in outright rejection. The process doesn't pause for you to fix it, it just fails.
And what happens next is what truly kills a startup's momentum and its finances, the mandatory timeout.
Exactly. After rejection, the regulator imposes a mandatory 6-month delay before you're even allowed to resubmit your application.
6 months.
Think about that for a startup. 6 months of zero revenue, overheads piling up, your engineering team getting demoralized, and your competitors are just rushing ahead. That delay alone, which can easily stretch to 9 or 12 months of total time-to-market loss, is a financial death spiral.
And that's exactly how you start racking up that massive financial failure cost we talked about. But it's not just rejection, right? Sometimes founders manage to file something that looks complete, but they've made fundamental structural errors.
These are the hidden traps, and they cost a fortune in both time and money.
Give me a concrete example of a costly classification error in the financial structure.
Well, the most common one involves capital classification. MiCA issuers have to meet minimum capital requirements. So a startup might aim for a smaller scale, do their calculations, and aim for, say, Class 1, which requires 50,000 euros in fixed capital.
And they build their whole plan around that number.
Their entire financial plan, their investor pitch, their operations, all based on 50K. But then the regulator reviews the actual functionality of the token and the size of the reserves and determines that, no, your structure actually requires the higher threshold, Class 2, which is 125,000 euros.
Wow. So they've fundamentally miscalculated the entire operation.
Instantly. They now need to raise an additional 75,000 in fixed capital, restructure their accounting, maybe go back to investors, all while the application clock is ticking.
Okay, that's a financial trap. But how does the tech setup, the core of the crypto product, trip people up?
The classic technical trap is custody. A lot of RT issuers try to claim their solution is a non-custodial wallet setup. They're hoping to avoid the really strict custody rules, the insurance requirements, and the capital mandates that come with being a regulated crypto asset service provider, or CASP.
Non-custodial, meaning the issuer never touches the customer's private keys. Seems simple enough.
It sounds simple, but the devil is always in the details of the smart contract logic. If the regulator finds any subtle mechanism, maybe the contract has an emergency veto function or a recovery procedure involves the issuer's centralized backend.
They'll reclassify it.
They will. The regulator uses what's called a functional assessment. If you can control the user's assets, even indirectly, you are a custodian, period.
And the moment that classification changes, the compliance burden just explodes.
Precisely. You suddenly need a full separate CASP license application, massive professional custody insurance, and entirely new operational procedures for key management. You can't just pivot to that overnight.
What's the real, tangible financial hit from these kinds of errors?
The source material quantifies this pretty clearly. These necessary redesigns and the legal rework to fix the mistake cost the issuer an estimated 20,000 to 50,000 euros in direct costs.
Okay.
And critically, they add another 2 to 3 months of delay to the launch timeline. This is money and time spent fixing fundamental mistakes that a specialized legal team would have spotted in week 1.
So, beyond the technicalities and the math, regulators are also judging the quality of the submission. What are the big qualitative red flags that just scream amateur hour to a regulator?
Well, first is vague risk disclosures in the white paper. It has to be brutally honest and hyper-specific. Boilerplate language like crypto is risky is just not going to cut it.
They want to see you've analyzed your own specific model.
Exactly. Second, inadequate management team experience. The regulator does a strict fit and proper assessment. If your CEO's background is just in marketing and the CTO has no experience in financial services security, it's an immediate flag.
They're looking for domain expertise.
Right. Third, insufficient ICT and DOR compliance. The bar for tech security is incredibly high, especially with the new Digital Operational Resilience Act. A submission that lacks detailed architecture diagrams or annual penetration testing plans is a non-starter.
And finally,
Unrealistic financial projections. Your 3-year business plan needs to be conservative and supported by verifiable assumptions. Overly optimistic revenue projections with underestimated compliance budgets are a major red flag that management just doesn't have a grip on reality.
So it's not about just forgetting to sign a form, it's about lacking the deep institutional knowledge in the first place, which brings us back to the total cost of failure. Let's quantify that again.
Okay, so the total estimated cost of trying this on your own. You factor in the lost revenue from an 8 to 12-month delay, the expense of redesigns, the legal rework, the internal staff time wasted on rejected applications. It ranges from a conservative €650,000 up to that staggering maximum figure of €2.4 million. Wow. And that number dramatically shows why specialized legal help isn't just an expense. It's an essential cost avoidance mechanism that de-risks the entire venture.
Okay, the problem is now painfully clear. DIY compliance is just too costly and too risky. So let's pivot to the solution. How does a specialized legal partner, one who really gets MiCA, approach this? The sources outline a very systematic, almost military-grade approach.
And that's the critical shift. The successful path turns this huge legal challenge into a structured, executable 3 to 6 month process. And the foundation of it all is what we call the lawyer-client tandem.
The tandem approach.
Yes. The client brings the deep business knowledge, the team, the strategy. They know their product. The legal partner brings the MiCA expertise, the regulatory relationships, and crucially, that deep understanding of the unwritten regulatory expectations. They know exactly what level of detail will satisfy the regulator.
And the first step isn't just creating documents, it's a strategic check-in. It's phase 1, strategic planning and pre-application. It takes about 1 to 2 weeks. And we highly recommend this proactive engagement with the national regulator. You have informal pre-application meetings to validate your business model and spot red flags before you formally submit anything.
Why is that validation so important?
Well, for one, it shows institutional maturity, which regulators like. But more importantly, it's where you confirm your classification. Is your token an RT? Is it an e-money token? Does it fall outside MiCA altogether? Avoiding that classification error alone saves months of rework later.
Makes sense. So once the strategy is locked down, you move into the heavy lifting. Documentation preparation, which is weeks 3 to 8. This is where those 13 categories get prepared. Let's drill down into the 5 most critical documents that really determine success or failure.
Okay, these 5 are the absolute pillars of trust. The white paper, reserve management, capital planning, the management assessment, and operational resilience, which is your ICT and DORA compliance. Let's start with the crypto asset white paper. This is the public's window into the token. But under MiCA, it's much more than a marketing doc.
Oh, it's a legal disclosure document. It has to be comprehensive, crystal clear, entirely accurate, and most importantly, non-misleading. The regulator is checking for 2 things: total transparency for the consumer and proof that the issuer actually has the operational substance they claim to have.
So what are the absolute must-haves, especially in the risks section? This seems to be where the boilerplate submissions fail right away.
So the risk section is mandatory, and it's under intense scrutiny. You can't just list risks. You have to analyze how they apply to your specific operation. You have to explicitly disclose and analyze things like value risk, liquidity risk, custody risk.
And technology risk, which for crypto is huge, smart contract bugs, hacking.
Huge. And also regulatory risk, the risk that MiCA itself could change, and even environmental risk. If your consensus mechanism uses a lot of energy, you have to detail the climate impact and your mitigation strategy.
That's extensive. It forces the issuer to think like an institutional risk manager. And you also mentioned there are mandatory warnings that sound almost painfully direct.
They are designed to be. They manage consumer expectations and remove any doubt. The white paper has to explicitly state, and very prominently, things like, this asset reference token may lose all or part of its value, and this art may not always be transferable or liquid.
And the really big ones.
The really big ones are that it is not covered by investor compensation schemes, and it's not covered by deposit guarantee schemes.
Which immediately shatters the assumption a retail investor might make that this is just like holding cash in a bank.
It is not. And if you fail to include those warnings, the regulator will reject you instantly on consumer protection grounds.
Okay, let's move to the second pillar. The reserve asset management policy. This is the financial core. If this is flawed, the whole token fails. Where's the complexity here?
The complexity is in the need for absolute precision, segregation, and constant verification. The policy must detail the exact composition of the reserve assets. You can't be vague. You have to state, for example, 75% EUR cash in segregated accounts, 15% German government bonds with less than 3 months maturity, and so on.
Down to the percentage point.
Down to the percentage point. And the policy has to detail the strict custody requirements. The assets must be held by a regulated entity, a licensed bank, an authorized crypto custodian, or a MiFID II investment firm.
And they have to be legally segregated.
That is the crucial protection mechanism. The assets must be legally walled off from the issuer's own corporate operating funds. It means if the issuer goes bankrupt, the token holders still have a legal claim on those reserves.
It's like a trust or an escrow.
Exactly. And to ensure this is all being followed, there's a mandatory continuous cycle of verification, monthly reconciliation, a mandatory quarterly independent audit, and public quarterly reporting of the balance sheet.
That's a high level of continuous auditing that a DIY effort just couldn't handle.
Okay, on to C, financial projections and capital plan. This is where you prove you can absorb shocks. How is the capital calculated?
It's a complex calculation. The issuer has to hold the highest of 3 specific figures. First, a minimum fixed capital of 350,000 euros. That's the floor.
Okay.
Second, 2% of the average reserve assets. So that part scales with your operation. And third, 1/4 of the prior year's fixed overheads to make sure you have operational runway.
So you have to constantly manage your capital to meet whichever of those 3 is highest at any given time.
Constantly. But the really crucial element, which goes way beyond the math, is stress testing.
Wow.
The regulator doesn't just care about your balance sheet today. They want to know what happens in a crisis.
Right, so what kind of adverse scenarios do they want to see planned for?
They want to know specifically how your capital will shield the operation if 50% of your customers try to redeem their tokens all at once in a panic.
Or how you'll cover losses if your reserve assets suddenly lose 10% of their value. You need to provide serious financial modeling, not just a simple forecast. This is where most DIY applications just completely fall apart.
Okay, next up is D management body fit and proper assessment, the personal scrutiny of the executive team.
Right. The regulator is basically asking, are these the right people to be trusted with potentially hundreds of millions of euros? So every key executive CEO, CFO, compliance officer has to submit detailed documentation proving both their good repute and their competence.
And what does good repute mean in practice?
It means recent criminal record checks from everywhere you've lived, confirmation of no sanctions or director disqualifications, a signed questionnaire. They're looking for any history of fraud or even professional negligence.
And competence means a deep background check.
Very deep. The CV has to highlight specific, relevant experience in financial services regulation, treasury management, or high-level blockchain security. A generic tech background is not enough. They also assess your time commitment and demand full disclosure of any conflicts of interest.
They need to be convinced the team, individually and collectively, has the knowledge, skills, and independence for the job.
Precisely.
Finally, let's talk tech. EICT systems, security, and DORA compliance. This is where the blockchain blueprint meets the regulatory hammer.
This section demands total transparency on your tech backbone. You need to provide a complete system architecture, description data flow diagrams, network segmentation, the works.
What are some non-negotiable security controls?
Documented standards for encryption, mandatory multi-factor authentication for all admin access, and, critically, evidence of preventative measures like regular vulnerability scanning and mandated annual penetration testing by independent third parties.
And what about private key management, the heart of any crypto operation?
Extreme detail is required. You have to explain your key generation, define the percentage of assets in cold storage, your multi-signature requirements, how many key holders, where they are, and robust audited recovery procedures.
And this has all been complicated further by DORA, the Digital Operational Resilience Act.
DORA is a game changer. As of January 1st, 2025, issuers must comply. It mandates specific board oversight of ICT risk and defined incident response plans.
And those plans have to meet regulatory standards.
Yes. Critically, you must have a procedure for notifying the regulator within 24 hours of discovering a major incident. And you have to define and prove you can meet your RTOs and RPOs, your recovery time and recovery point objectives.
Which basically means you have to prove, not just claim, that you can recover from a disaster with minimal downtime and data loss.
It's the ultimate test of operational reality. And that's just the top 5. The other 8 categories cover everything else you'd expect from a functioning financial institution. It's an overwhelming amount of material, which shows exactly why trying to do this internally leads to certain rejection.
We've laid out the sheer volume of material needed, so let's get back to the timeline. You said the DIY approach takes 8 to 12 months minimum, while the expert approach is 3 to 6. How is that acceleration even possible?
It's all about expertise and precision. The goal is to achieve complete status on the very first formal submission, which happens around week 9 in the structured approach. Because the legal partner has the templates and anticipates what regulators want, the submission is sound from day one.
And that avoids the deficiency notices.
Exactly. It avoids the back and forth that adds weeks or months to the process when regulators spot missing details.
So once the application is accepted as complete, what happens during the substantive assessment phase? That's about 4 to 6 weeks.
This is the deep dive from the regulator. They shift from checking if the documents are there to checking if the issuer meets all the MiCA requirements in substance. They assess those 4 key pillars: financial soundness, governance quality, operational resilience, and consumer protection.
And this is where the big EU bodies get involved, right? The EBA, ESMA, the ECB. That must add another layer of complexity.
It's an automatic layering designed to ensure stability. The national regulator has to send the application to the EBA and ESMA, who have 20 working days to issue opinions.
What are they looking for?
ESMA focuses on market integrity and consumer protection. The EBA looks at financial stability and classification. And the ECB assesses whether the RT, especially a big euro-denominated one, poses any risk to the Eurozone financial system or monetary policy.
A negative opinion from the ECB could be fatal.
It can absolutely kill an application. And this is all happening in the background, which is why having a legal partner who can manage that dialogue is so important.
Even with perfect documentation, the sources say information requests, or IRs, are inevitable. This isn't a sign of failure, but part of the dialogue. What kind of specifics do they ask for?
They want hard evidence. They'll ask things that really test your planning. For example, you say you can handle a redemption spike. Please provide the results of your latest liquidity stress tests.
So they want to see the numbers.
They want the numbers. Or you claim your custodian is insured. Provide the insuring certificate and show the coverage is sufficient. Or your CTO's CV is general. Provide specific details of projects where they implemented multi-signature cold storage in a regulated environment.
These are highly technical operational questions. Drafting detailed evidence-based responses is where the expert guidance really pays off.
It is. A novice might panic. An expert knows exactly what piece of evidence the regulator needs, and timing is everything. An expert can draft a comprehensive reply in days. A novice team might take weeks, extending the whole process and risking another error.
Okay, let's bring it back to the money, the ROI. The potential cost of a DIY failure is up to $2.4 million. The professional services cost is what, 20 to 60,000 euros? How does that smaller investment create such a huge return?
It's a classic cost-benefit analysis. The avoided costs are just exponential. First, the legal fees are a fraction of the cost of your internal staff, time wasted on failed attempts, which the sources estimate costs between 1 and 300,000 euros.
But the biggest savings are from avoiding delays. Lost revenue kills startups.
That's the one. Avoiding that 6-month rejection delay and launching in 3-6 months instead of 8-12 generates an immediate revenue boost that's estimated at €500,000 to €2 million. That's opportunity captured.
And you're also avoiding the rework costs.
Right, another 50 to 100,000 saved there. So the net savings from using expert counsel are well over 800,000 euros. The sources confirm this. It's often a 10-to-1 return on investment just by mitigating failure and getting to market faster.
And beyond the money, there's the massive competitive advantage of being regulated.
That's the long-term strategic win. A license from a respected regulator like the Czech National Bank is a huge trust signal. It creates a competitive moat, and it grants you EU passporting.
Meaning, one license lets you serve all 30-plus countries in the European Economic Area.
Immediate massive scale, all achieved through regulatory trust.
Yeah.
Meanwhile, the unregulated competition, they're going to be forced offline as MiCA enforcement tightens. The window for early movers is closing fast.
The sources note there are fewer than 100 licensed RT issuers now, but hundreds of applications will be pending soon.
Exactly. Getting licensed now secures market share while your competitors are stuck in that painful, expensive cycle of rework and rejection.
This deep dive has made one thing abundantly clear. Launching an RT in the EU requires a total and irreversible shift in mindset. That old crypto adage of move fast and break things it's been decisively replaced.
It's been replaced by precision, expertise, and demonstrable substance.
Substance, that's the key word.
It is. That's the true synthesis. Regulators are focused entirely on substance over form. They aren't satisfied with neatly written policies. They demand proof of operational reality, genuine governance independence, a management team that is technically and financially competent, and a real compliance culture.
They need to see that the systems protecting consumer funds are not just theoretical, but robust, stress-tested, audited infrastructures that can actually handle a crisis.
The bar has been set incredibly high. It limits entry to teams with institutional maturity and backing, but the rewards access to that massive EU market and the trust of global finance are proportional.
And as you said, the sources point out that fewer than 100 RE issuers are licensed across the entire EU right now. It's a vast market waiting to be captured, and that early mover advantage is significant, but fleeting.
Which raises a really profound question for you, the listener, to think about. If the strict requirements of MiCA, this high barrier to entry, the need for expensive legal teams, if this all means that only large, well-funded, deeply compliant entities can launch RTs, what does that ultimately mean for the decentralization ethos that once defined crypto?
Does this regulatory moat ultimately guarantee the long-term stability and acceptance of crypto by filtering out the risky players?
And how will consumers react when the thousands of small, unregulated stablecoin competitors are inevitably forced offline by national regulators in the coming year? The future of institutional crypto may depend entirely on the answer to that.
A truly compelling thought. That compliance is now the core driver of both stability and market consolidation. We hope this is giving you the roadmap and the critical warning for navigating the complex, high-stakes world of MiCA authorization.